Same two funds, SPY and QQQ. Same starting day in 1999. The only thing different is how the money goes in. Scenario 1, lump sum, $100,000 in the Nasdaq 100 on March 10th, 1999. $100,000 into the S&P 500 on the same day. 27 years later, the QQQ account is worth $1.65 million. The SPY account is worth $921,000. QQQ wins by $729,000. Scenario 2, dollar cost averaging. Both accounts start with $10,000 and contribute $500 a month to present day. Total dollars in, $173,000. QQQ is worth $2.1 million and SPY is worth $1.1 million. QQQ wins by over $1 million on far less money in. Most comparisons look at the lump sum return and call it a day. That actually misses the way most people invest, paycheck by paycheck. And when you run the same SPY versus QQQ comparison with dollar cost averaging, the gap does not shrink, it gets bigger. That difference is the entire point of this video. There's also a third number worth sitting through the video for, a correlation between SPY and QQQ that's climbed from 0.82 in the dot-com era to 0.95 today. And it changes everything you think you know about which fund is a safer choice. We'll get into that at the end. But before any of that, there's something about these two funds you have to understand. Most SPY versus QQQ comparisons online focus on returns. They miss the structural differences in what's actually inside each one. SPY tracks the S&P 500, 500 leading U.S. large cap companies weighted by market cap. You can own the S&P 500 through SPY, VOO, IVV, low-cost portfolio ETFs, or mutual funds inside most workplace plans. Any of them gets you in the same underlying index. QQQ tracks the Nasdaq 100. 100 largest non-financial companies listed on the Nasdaq exchange. The choices are more limited here. QQQ from Invesco is the main one. Then there's QQQM is the lower cost version with the same holdings. And then the Fidelity, Vanguard, Schwab, they do not own their own Nasdaq 100 mutual funds. If you want Nasdaq 100 exposure in a workplace 401k, the options are usually limited. There's a structural reason a lot of investors end up with S&P 500 exposure by default. And one more thing for the options crowd, SPY and QQQ are among the most liquid ETFs in the world for options. If you ever want to write covered calls or use leaps, these two are the ones with the deepest option chain and the tightest spreads. The lower cost alternatives trade fine for buy and hold, but don't have the same options market. Now the rules for getting in. The S&P 500 has a profitability requirement. A company has to be US based, it has to be profitable, positive earnings in the most recent quarter, and positive earnings summed across the trailing 4 quarters. The S&P Index Committee approves additions. It's a curated list with a quality screen baked in, and the S&P 500 doesn't care which exchange a company is listed on. New York Stock Exchange, Nasdaq, it doesn't matter. The Nasdaq 100 is different. The listing requirement is the whole story. If a company is on the New York Stock Exchange, it's not eligible, period. And there's no profitability requirement. A company can be losing money and still be in the index as long as it's Nasdaq listed and has a top 100 market cap. Salesforce is the cleanest example of the listing rule. About a $150 billion company, roughly $7.5 billion in net income last year. It's not in the Nasdaq 100 because it's listed on the New York Stock Exchange. And Salesforce has no real motivation to move. It's already in the S&P 500 since 2008 and the Dow Jones since 2020. 2 huge index inclusions already forcing institutional buying. The marginal benefit of adding the Nasdaq 100 would be small. But then look at a company like Palantir, which went the other way. By September 2024, Palantir was already in the S&P 500. 6 weeks later, in November, the company announced it was moving its listing from the New York Stock Exchange to the Nasdaq. Their press release said specifically they were doing it to become eligible for the Nasdaq 100. A month after the listing transfer in December 2024, Palantir was added to the Nasdaq 100. Now Palantir gets the index buying tailwind from both indices. There's a culture pattern at work here too. For 50 years, tech companies have disproportionately chosen Nasdaq for their own IPO because of cost, listing flexibility, and the brand fit with high-growth, disruptive companies. Old economy names, financials, and dividend payers have disproportionately chosen the New York Stock Exchange for the heritage and the specialist model. The Nasdaq 100 isn't engineered to be tech-heavy. It just inherited 50 years of self-selection that landed most of the tech founders on Nasdaq and most of the dividend payers on the New York Stock Exchange. There's a diversification question worth looking at. SPY has 500 holdings. QQQ has 100. On paper, SPY looks much more diversified, but in practice, the math says something different. The top 10 holdings in SPY make up about 36% of the entire fund. The top 10 in QQQ make up about 50%, and those top 10 are mostly the same companies: Apple, Microsoft, Nvidia, Alphabet, Amazon, Meta, and Broadcom. The 490 other stocks in SPY combined make up about 65% of the fund, but each individual one moves the needle a tiny amount. A 5% move in JP Morgan, which is about 1.2% of SPY, adds about 0.06% to SPY's daily return. A 5% move in Nvidia at 8% weight adds 0.4%, almost 7 times the impact from one stock. So the day-to-day price action in both funds comes from the same handful of mega-cap tech names. For now, hold on to that thought because it will matter at the end. And with that, the data. All numbers from here are total return, dividend reinvestment included. SPY currently yields about 1%. QQQ currently yields about 0.5%. Those numbers move as prices move, but the gap is structural. SPY pays more because the S&P 500 includes more dividend-paying companies. Over 27 years, the gap compounds and the data accounts for it. Back to the lump sum scenario, $100,000 in each fund on March 10, 1999, the day QQQ started trading. 27 years later, the QQQ account is worth about $1.65 million. The SPY account is worth $921,000. QQQ, like we said, wins by $729,000. In CAGR terms, that's roughly 10.9% per year for QQQ versus 8.5% per year for SPY. Both of them crushed the long-run average. Neither was a loser, but QQQ ended up nearly twice the value. And that's the headline: QQQ wins from inception. But the lump sum headline hides something very important. Split the 27 years into two pieces and the picture changes. From inception in March 1999 through the great financial crisis bottom in March 2009, 10 full years, $100,000 in QQQ became $52,000, down nearly half. $100,000 in SPY became $62,000, down nearly 40%. CAGR was negative for both, negative 6.4 per year for QQQ, negative 4.7 per year for SPY. Both funds lost money on buy and hold basis over a full decade. From the great financial crisis bottom forward, though, 17 years and counting, $100,000 in QQQ from that date became $3.2 million, CAGR of about 22% per year. $100,000 in SPY became about $1.5 million, the CAGR of 17% per year. Both annihilated the long-run average, with QQQ more than doubled the SPY result. So the entire 27-year outperformance happened in the second segment. QQQ didn't steadily beat SPY across 27 years. It got crushed for a decade and then ran for 17 years. The lump sum holder who held the line ended up richer, and the lump sum holder who capitulated in the first decade didn't. Now, to understand the actual risks involved with the drawdowns, we'll look at 5 major drawdowns since QQQ launched, all daily close, peak to trough. The dot-com crash, 2000 to 2002. QQQ was down 83%. SPY was down 49%, a gap of 34 points. And here's the number that explains what that drawdown actually meant. A $100,000 lump sum investor in QQQ at March 2000 peak didn't recover to break even until February 2015. That's nearly 15 years underwater. The same $100,000 into SPY recovered by December 2010, less than 11 years. That's the path dependency cost that the headline return number hides. The financial crisis, late 2007 to early 2009. QQQ was down 54%, while SPY was down 57%. SPY was actually worse. COVID, early 2020, QQQ down 29%, while SPY was down 34%. So once again, SPY was worse. The 2022 bear market, QQQ down 36%, SPY down 25%. That one, QQQ lost by 11 points. The 2025 tariff sell-off, where QQQ was down about 23%, hitting bear market territory, and SPY was down about 19%, just shy of it. In those 5 major drawdowns, QQQ was meaningfully worse in only 2, the dot-com and the 2022 bear. In the other 3, QQQ matched or beat SPY. The narrative that QQQ has worse drawdowns across the board is not what the data shows. There's also the daily volatility question. On any given day, QQQ moves about 1.25 times as much as SPY in the same direction. If the market is up 1%, QQQ is typically up 1.2 to 1.5%. If it's down 1%, QQQ is down 1.2 to 1.5%. That's structural. QQQ has higher beta because it's more concentrated in higher beta growth names. But here's the pattern in the drawdown worth flagging. The two drawdowns where QQQ underperformed materially in the dot-com and the 2022 bear, they were both specifically mega-cap tech-driven moves. The other three were broad market crashes or rate-driven moves, and those hit both funds similarly. The pattern tells you what kind of crash QQQ is most exposed to. Whether SPY actually protects you from that specific type of crash is the question we'll answer at the end. For now, back to the dot-com. The 83% drawdown is the one that matters. To understand whether that can happen again, you have to understand why it happened. In 2000, QQQ wasn't just more tech-heavy, it was exposed to a market where speculative growth, unprofitable companies, and extreme valuation assumptions were far more common. The broader Nasdaq ecosystem was full of companies like Pets.com, eToys, TheGlobe.com, and Webvan. And even inside the Nasdaq 100, a much larger share of the index was tied to cash-burning or aggressively valued growth businesses than it is today. When the bubble burst, the market wasn't just marking prices down, it was repricing business models that had never proved they could earn money. Some companies went to zero. Others were removed from the index entirely. Today's QQQ is different. It is still concentrated. It is still growth heavy. It can still underperform badly when rates rise or mega cap tech gets repriced. But most of the weight sits in profitable, cash-generating companies with real revenues and global scale. Even the names that aren't profitable on a GAAP basis, they tend to be real businesses in transition. Intel restructuring its foundry business, Warner Brothers Discovery digesting a merger, Marvel investing heavily in AI infrastructure, those aren't shell companies with internet addresses. The honest counter-argument is valuations, depending on the source and whether you use trailing or forward earnings. The Nasdaq 100 trades into mid to high 30s on earnings. The S&P 500 is closer to the mid-20s trailing or in the low 20s forward. The exact number moves, but the point is the same. QQQ trades at a meaningfully higher multiple than the broader market. That doesn't mean it's overvalued. The Nasdaq 100 companies are growing earnings faster, and a higher multiple on faster growth can be justified. But it does mean that if AI CapEx doesn't deliver the revenue everyone expects or earnings growth slows, then there's room for multiples to compress. So back to the lump sum scenario. As you can see, it took on real volatility to get the higher return. Whether the next 27 years pays off the same way depends on the multiple question we just talked about. Now the second scenario. Most people aren't dropping $100,000 on a single day. They're contributing from a paycheck. So let's run the realistic version. Scenario 2, dollar cost averaging, starting in March 10th, 1999 with $10,000 in each fund and contributing $500 a month from each paycheck to each fund. Total dollars contributed over 27 years, $173,000 per fund. Here's what happens. By October 2002, after 3.5 years of contributions, the QQQ side of the dollar cost averaging scenario had $31,500 contributed. The account was worth $13,000, down 58% on the money that had gone in. Now think about this for a second. You've been making contributions every paycheck for about 3.5 years. Your account is worth less than half of what you've put in. The natural response is to stop contributing, the move to cash, to get out. However, if you held the line, the QQQ side of the dollar cost averaging scenario is worth $2.1 million today. And with the same scenario in SPY, by October 2002, the SPY side had $20,000 on $31,500 contributed, down 36%. Painful but less catastrophic. By the great financial crisis bottom in March 2009, both sides had about $44,000 on $70,000 contributed, down roughly 37% each. From 2009 forward, every dollar of contributions went into a recovering market. By early 2015, the QQQ side was at about $253,000 on $105,000 contributed. The SPY side was at about $207,000. By today, the QQQ side of the dollar cost average scenario is at $2.14 million. The SPY side is at $1.07 million. QQQ wins by over $1 million. The dollar cost averaging investors' money-weighted return was 14.6% for QQQ versus 10.9% for SPY. The lump sum CAGR was 10.9% for QQQ and 8.5% for SPY. That's a difference between 2.4 and 3.7 percentage points a year higher just from how the money went in. And that's the whole reason this scenario looks so different. The lump sum investor put all the money in at once and had to absorb the full crash. The dollar cost averaging investor started small and kept adding during the collapse. The $500 going into QQQ in October 2002 was buying shares at around $20. The same $500 in March 2009, $28 a share. The SPY contributions during those same crashes bought at deep discounts too. Those ugly contributions became the future engine. But here's the hard part. The QQQ dollar cost average account was underwater on total contributions for more than 10 years, from March 1999 to September 2009. The SPY account spent over 3 years underwater too, but both investors had to keep buying while the account was worth less than the dollars they had put in. The ones who held the line ended up with $2.1 million in QQQ and $1.07 million in SPY. The ones who quit in 2002 or 2008 got neither number. And as you can tell, discipline is the entire story for the dollar cost averaging investor. The most important number in this video may not be the return, it may be the correlation. In the dot-com era, the daily correlation between SPY and QQQ was about 0.82. By 2008, it was 0.88, and by 2019, it was 0.92. Over the last 5 years, 0.95. 0.95 means that these two funds, they move together far more often than they actually move differently. They are not opposite bets. They are similar bets at different concentrations. QQQ is still more volatile and more exposed to growth stock repricing, but SPY is not a clean hedge against that risk. If mega cap tech gets hit hard, SPY gets hit too. That changes the comparison. If your goal is maximum long-term growth and you are still adding money, the historical dollar cost averaging data favored QQQ, but only if you kept contributing through brutal drawdowns. If your goal is broader exposure across more of the U.S. economy, SPY still makes sense. That is why I personally build my core around the S&P 500. The S&P 500 has always rotated toward the dominant engine of the American economy: railroads, industrials, financials, and now technology. But technology today is not just a sector, it's the infrastructure layer underneath almost every sector. Walmart runs on the technology, JP Morgan, Pfizer, they all run on technology. The S&P 500 captures that evolution automatically, whether the company is officially classified as tech or not. That is the natural selection argument for owning the index. If your goal is actual protection from a mega cap tech crash, SPY may not be enough by itself. Real diversification has to come from assets that behave differently: treasuries, value, international, dividend-oriented funds, or whatever fits your own system. The answer is not QQQ good, SPY bad. It is not SPY safe, QQQ risky. These funds are closer than most investors think. SPY may give you broader exposure. QQQ gives you more concentrated exposure to the companies driving most of the market's growth, but both are tied to the same mega cap engine. That is the real data lesson. Tell me in the comments, if you had to pick one for the next 20 years, SPY or QQQ, which one are you choosing and why? I want to hear it. Also, if you have two ETFs that you want to see compared on this channel, then let me know. If this changed how you think about the comparison, hit the like button. And if you want rules-based investing content without the hype, subscribe. Stay disciplined, stay patient, and I'll see you on the next flight.